In 476 AD, the last Roman emperor handed over his crown to a Germanic warlord, but the empire didn't die that day. It had been bleeding out for over 2 centuries, weakened by forces that historians still debate today. Most people point to invasions, corruption, and moral decay, but there's one cause that almost never makes the headlines. It's not dramatic enough, it doesn't involve battles or betrayals. Rome printed itself to death. It debased its currency so thoroughly that the entire economic foundation of the empire crumbled from within. And the exact same pattern that killed the greatest empire in human history is now unfolding in America. Some analysts believe we have roughly 5 years before the damage becomes irreversible. This isn't fear-mongering or speculation. It's arithmetic. It's the same arithmetic that destroyed Rome. And by the end of this, you'll understand why so many people who study history, who understand monetary systems and debt cycles, are quietly preparing for what comes next. Rome wasn't always broke. At its peak, the empire stretched from Britain to Mesopotamia, encompassing most of the known world. Its currency, the denarius, was the dollar of the ancient world. Merchants from the Silk Road to the coast of Africa accepted it without question. And for good reason. The denarius was made of nearly pure silver, 95% to be exact. It held value because it was real. You could melt it down, and the metal would still be worth something. But empire is expensive. Wars cost money, legions needed to be paid, and there were hundreds of thousands of soldiers stationed across 3 continents. Citizens expected bread and entertainment. The famous phrase, bread and circuses, wasn't a metaphor. It was official policy. Free grain distributions, free gladiator games, free chariot races, all funded by the imperial treasury. And when the treasury ran low, emperors discovered something dangerous. They didn't need to raise taxes or cut spending. Both were politically risky. Instead, they could simply reduce the silver content in the coins. Nobody would notice at first. The coins looked the same, they felt the same, only their intrinsic value had changed. So, that's exactly what they did. Under Nero, in the 1st century, the silver content dropped to 90%. Under Marcus Aurelius, 100 years later, it fell to 75%. By the time of Septimius Severus, it was down to 50%. And by the reign of Diocletian in the late 3rd century, the denarius contained less than 5% silver. It was a coin in name only. The result was predictable to anyone who understood economics. But at the time, it seemed to come as a shock. Prices exploded. What once cost 1 denarius now cost 50, then 100, then more. Citizens who had saved their entire lives watched their wealth evaporate in real time. Merchants refused to accept Roman coins, demanding payment in gold, in goods, or in foreign currency. Trade collapsed. The economy that had powered the known world for centuries ground to a halt. And the government's response? More coins, more debasement, more desperation. They were trapped in a death spiral with no exit. Now, look at the American dollar. In 1913, when the Federal Reserve was created, a dollar could buy what roughly $30 buys today. That means the dollar has lost about 97% of its purchasing power in just over a century. That didn't happen by accident. It happened by design. Every time the government needed to fund a war, a bailout, or a stimulus program, it created more money. Not by mining silver or gold. There was no new wealth backing these dollars, just the promise of the United States government, and increasingly, just the faith that the system would continue functioning. Between 2020 and 2022, in response to the pandemic, the Federal Reserve increased the M2 money supply by over 40%. To put that in perspective, some estimates suggest that roughly 80% of all dollars in existence were created in just the last several years. That's not an exaggeration, that's Federal Reserve data, available for anyone to check. And just like in Rome, the consequences showed up quickly, at the grocery store, at the gas pump, in rent prices and mortgage rates, in the cost of everything that ordinary people need to survive. The inflation that followed wasn't a mystery. It was a direct, predictable result of flooding the system with newly created currency. But here's what most people miss. This wasn't a one-time event. It wasn't an emergency measure that will be reversed. It's a pattern that has been accelerating for decades, and there's no sign that it's stopping. The Roman government didn't just debase its currency, it borrowed heavily. At first, the debt funded genuine expansion. New roads that connected the empire, new aqueducts that brought water to cities, new territories that would eventually pay for themselves through taxes and trade. But as the empire stretched thinner, the nature of the borrowing changed. Rome started borrowing not to build, but to survive, to pay soldiers who might otherwise revolt, to feed the capital's population who might otherwise riot, to service the interest on previous debts. Sound familiar? America's national debt now exceeds $34 trillion. That's a number so large it's almost impossible to comprehend. So, let's make it real. If you spent $1 every second, it would take you over 1,000,000 years to spend $34 trillion. But here's the number that matters more. The federal government now pays over $1 trillion per year just in interest on that debt. Not principal, just interest. That's more than the entire defense budget, more than Medicare, more than education, transportation, and infrastructure combined, more than everything except Social Security. And here's the trap. The debt is growing faster than the economy, which means the interest payments will keep rising, which means the government will need to borrow more just to cover the interest, which means the debt grows even faster. It's a loop with no escape. The Congressional Budget Office has projected this out. Their own numbers, published for Congress to see, show that within the next decade, interest payments could consume nearly a quarter of all federal revenue. At some point, the math simply stops working. You can't borrow your way out of a borrowing problem. Every dollar spent on interest is a dollar not spent on defense, infrastructure, or anything else. Rome learned this lesson. America is learning it now. But here's where the story takes a more dangerous turn. Rome's currency wasn't just used in Rome. It was the reserve currency of the ancient world. Kingdoms and merchants across 3 continents held denarii in their treasuries because they trusted it. That trust gave Rome enormous power. It could run deficits that would have bankrupted other nations. It could fund wars far beyond its means. It could import goods without exporting much in return. All because the world needed Roman money. The United States has enjoyed the same privilege since 1944. That's when the Bretton Woods Agreement made the dollar the global reserve currency. Other currencies were pegged to the dollar. The dollar was pegged to gold. And America became the center of the global financial system. For decades, countries around the world have held dollars in their central banks. They've priced oil in dollars. They've settled international trade in dollars. This created what economists call exorbitant privilege. America could print money and export inflation to the rest of the world. It could run trade deficits year after year because everyone else needed dollars anyway. But that privilege is not permanent, and the cracks are starting to show. China and Russia have been settling trade in yuan and rubles, cutting the dollar out entirely. Saudi Arabia has signaled willingness to accept non-dollar payments for oil, something unthinkable just a decade ago. The BRICS nations, Brazil, Russia, India, China, and South Africa, are openly discussing alternatives to dollar dominance. They're building new payment systems, new trading arrangements, a new financial architecture that doesn't require the United States. And central banks around the world are doing something they haven't done in decades. They're buying gold, not small amounts, record amounts. In 2022 and 2023, central bank gold purchases hit levels not seen since the 1960s. China, Russia, India, Turkey, Poland, and others have been stockpiling bullion at a pace that has surprised analysts. They're not doing this because they love shiny metal. They're doing it because they're hedging against the dollar. When the nations that hold your currency start quietly exchanging it for something else, that's not a vote of confidence. That's preparation. But empires don't collapse at the top first. They rot from the middle. In Rome, the decline was felt most acutely by ordinary citizens. In the early days of the empire, a Roman soldier could serve 20 years and retire with land and savings enough for a comfortable life. A craftsman could own a home in the city. A farmer could pass his property to his children and his children's children. By the late empire, that was gone. Wages couldn't keep up with the rampaging inflation. Taxes crushed small landowners who couldn't afford the bribes that larger estates could pay. Many citizens gave up their land entirely, unable to survive independently, and became tenant farmers on estates owned by the ultra-wealthy. They traded freedom for security. The middle class didn't just shrink, it was hollowed out, replaced by a society of elites at the top and dependence at the bottom. Now, consider America. In 1970, roughly 60% of American households qualified as middle class by income standards. Today, that number is closer to 50% and falling. Home ownership for young adults has plummeted to levels not seen in decades. The median home price is now over 10 times the median income in many major cities, a ratio that makes ownership impossible for most families without generational wealth. Student debt, medical debt, and credit card debt have all reached all-time highs. Wages, adjusted for inflation, have barely moved in 40 years, while the cost of housing, healthcare, and education has soared. Meanwhile, the top 1% now holds more wealth than the entire middle class combined. This concentration of wealth isn't just a statistic, it's a symptom. When the middle class collapses, so does the stability of the entire system. Rome learned this the hard way. The legions that once defended the empire with pride were increasingly filled with mercenaries and foreigners who had no loyalty to Roman values or institutions. The citizens who once built the roads and aqueducts and temples had been reduced to dependence of the state, surviving on handouts rather than their own labor. The foundation crumbled, and the structure followed. The strangest part of Rome's collapse is that people saw it coming. Historians and philosophers warned about what was happening. Some emperors even tried to stop it. Diocletian attempted sweeping reforms near the end. He tried to freeze prices through imperial edict. He reorganized the military. He split the empire into more manageable pieces, hoping that smaller units could be governed more effectively. But it was too late. The debasement had already done its damage. The trust was already broken. The people who could have stopped it earlier either didn't believe the warnings or didn't care enough to act when action might have mattered. Today, the warnings are louder than ever. Economists like Nouriel Roubini, who predicted the 2008 crisis, have written extensively about debt spirals and reserve currency transitions. Ray Dalio, one of the world's most successful investors, has produced detailed studies comparing America to past empires in decline. Former Federal Reserve officials have questioned the sustainability of current monetary policy. Even the Congressional Budget Office, a nonpartisan agency with no political agenda, has published report after report calling the fiscal trajectory unsustainable. The word they use isn't challenging or concerning, it's unsustainable. But the political system seems incapable of responding. Cutting spending is politically painful. It means taking away benefits that people have come to expect. Raising taxes is politically dangerous. It means asking people to sacrifice today for a future they might not live to see. So the default option is to keep borrowing and hope that growth solves the problem. Hope that some future technology or productivity boom makes the debt manageable. But hope is not a strategy, and the gap between official reassurances and underlying reality keeps widening. Officials say inflation is under control, but anyone who buys groceries or pays rent knows the truth. Officials say the banking system is strong, but regional banks have been quietly failing, and the Fed has created emergency lending facilities to prevent a cascade. Officials say the debt is manageable, but the interest payments tell a different story. This phase has a name. It's called denial, and it usually comes right before the reckoning. So, what does 5 years actually mean? It's not a countdown to a Hollywood-style collapse where everything falls apart on a specific date. Empires don't fall on a schedule, but several critical pressure points are converging within that window. Social Security's trust fund is projected to be depleted by the early 2030s. If nothing changes, benefits could be automatically cut by roughly 20 to 25%. That would affect tens of millions of retirees who depend on those payments to survive. The Medicare Trust Fund faces a similar timeline. Meanwhile, debt interest payments are on track to exceed all discretionary spending within this decade. The dollar's reserve status is being actively challenged, and viable alternatives are being built for the first time in 80 years. The Federal Reserve faces an impossible trilemma: raise rates to fight inflation and risk crashing the economy and the housing market, or keep rates low and let inflation continue destroying purchasing power, or try to thread the needle and probably fail at both. Every option leads to pain. Some analysts believe a major currency crisis could be triggered by a geopolitical shock, a failed treasury auction, or a sudden loss of confidence in dollar-denominated assets. Others think the decline will be gradual, a slow erosion of purchasing power and living standards spread over years or decades. Either way, the window for meaningful reform is shrinking rapidly. And the longer the system runs on borrowed time and borrowed money, the more violent the eventual correction tends to be. History shows that when these collapses happen, they often arrive faster than anyone expects. Rome's final century saw periods of apparent stability, followed by sudden crises that nobody anticipated. The same pattern is likely for America. The question isn't whether adjustments are coming, it's whether they'll be managed in orderly or catastrophic and chaotic. And here's the part that rarely gets discussed. The people who understand history and monetary systems aren't waiting for the government to fix this. They're preparing. In the final decades of Rome, the wealthy converted their assets into land and gold. They built fortified estates in the countryside. They paid private armies for protection. They understood that when the currency collapsed, real assets would hold value while paper promises became worthless. Today, the pattern is repeating. Billionaires have been buying farmland at an unprecedented pace. Bill Gates is now the largest private owner of farmland in America. Institutional investors have been rotating out of bonds and into commodities, real estate, and hard assets. Family offices serving the ultra-wealthy are increasing their allocations to gold, silver, and other stores of value that don't depend on government promises. And central banks, the very institutions that manage fiat currencies and are supposedly confident in the system they oversee, are stockpiling gold like never before. In 2023 alone, central banks added over 1,000 metric tons of gold to their reserves. That's not speculation or conspiracy theory. That's verified data from the World Gold Council. These institutions are not panicking publicly, but they are positioning privately. They see the same data everyone else can see, but unlike most people, they're acting on it. Meanwhile, the average citizen is told everything is fine, that inflation was transitory, that the debt is manageable, that the system is stable and will remain so indefinitely. The disconnect between what insiders are doing and what the public is being told is striking. And it raises an uncomfortable question. If the people who run the system are quietly protecting themselves with hard assets and real wealth, what does that say about their confidence in the system's future? There's a famous quote often attributed to Hemingway. When asked how he went bankrupt, he supposedly answered, "Gradually, then suddenly." That's how empires fall too. Gradually through small compromises and quiet decisions that each seem harmless on their own. A little more debt, a little more currency creation, a little more concentration of wealth. Then suddenly, when the accumulated damage becomes impossible to ignore and the system snaps. Rome didn't collapse because of one bad emperor or one military defeat. It collapsed because of 100 small choices that all pointed in the same direction. More debt, more debasement, more concentration of wealth at the top, more dependence at the bottom, more bread and circuses to distract from the decay. America is not Rome. We have technology Rome couldn't imagine. We have global trade networks that didn't exist. We have the ability to learn from history in ways that were never possible before. But learning requires humility. It requires admitting that we are not immune to the forces that brought down every empire before us. And so far, the evidence suggests that humility is in short supply. The same patterns keep repeating. The same justifications keep being offered. The same warnings keep being ignored. Maybe this time is different. Maybe the system will find a way to grow out of its debt, restore the middle class, and maintain the dollar's dominance forever. But if you're betting on that outcome, you should at least understand what you're betting against. You're betting against mathematics that have never been defied. You're betting against history that has repeated dozens of times. And you're betting against the revealed preferences of the very institutions that manage the system. Those are long odds. The Roman citizens who trusted their government until the end paid the highest price. Their savings vanished. Their property was seized through taxation or inflation or both. Their way of life disappeared within a single generation. They had no warning except the ones they chose to ignore. We have the same warnings. The data is public. The patterns are documented. The history is written. The question is what we'll do with that information. 5 years is not a deadline carved in stone. It's a window to understand what's really happening beneath the surface of reassuring headlines. A window to learn from the mistakes of empires past. a window to make decisions based on reality rather than hope. Empires don't send out press releases before they fall. They don't give 90-day notices. They decline quietly, then collapse loudly. Rome's citizens thought their world was permanent. They thought the legions would always protect them, and the grain would always arrive, and the currency would always hold value. It didn't. Every assumption they made was eventually proven wrong. The question you should be asking isn't whether America can fall. Every empire eventually does. The question is whether you'll recognize the warning signs in time to prepare, and whether you'll have the clarity and courage to act before it's too late.